Vacancy rates in the US have continued to go up in 2025, and here's what it could mean for you as a real estate investor, as a landlord, and maybe you're just curious as a renter. I want to dive into some of the cities that have some of the highest vacancy rates and some of the lowest vacancy rates, and how each of these vacancies translate into how it can affect your portfolio and by how much. And so I want to go over and show you the math on what that looks like. But before I do, let's go over the data on what that looks like, what these vacancies look like in these cities. And you might have seen articles just like this. The US has more fancy apartments than it's able to fill. You might have articles like this too: housing market corrections in Sunbelt cities, implications for real estate and mortgage investors. So here is the latest vacancy data. The national rental vacancy rates are at about 7% in Q2 of 2025. That's up from 6.6% in 2024. And for single family rental occupancies, it's around 95% as of June 2025, which is about a 5% vacancy. And in the multifamily side of things, the occupancy is quite similar, 94.7% nationally in Q2 of 2025, and stabilized properties at 94.4%. So it's been the lowest in over a decade, which is great. But the Sunbelt regions have been struggling. So markets like Austin, Texas, Phoenix, Arizona, Dallas, Texas, and Houston, Texas are sitting closer to 92 to 93% occupancies with about a 7 to 8% vacancy. And some luxury properties in oversupplied metros, they're seeing vacancy rates up to 15%. And that's from Q1 2025 data. So let's go over some markets that are seeing strong multifamily occupancy. So number one, New York City at 98.4% occupancy. They're the tightest major market in the US and historically have always been, just because they have such a vast population and is one of the most populated cities in the US. New Jersey sits at 97.1% occupancy, Boston, Massachusetts at 96.5% occupancy, San Diego, California at 96.1%, and Chicago, Illinois at 96% occupancy. And these are all supported by job diversity and steady demand. And that's why the occupancies have been going up. And also not an oversupply of new developments in these areas. Now, the struggling markets at the moment with higher vacancies are Austin, Texas at 92.5% occupancy, Phoenix, Arizona, Dallas, Fort Worth, Texas, Houston, Texas, 92.5 to 93% occupancy. So you can see Texas is struggling a little bit at the moment. And these luxury Sunbelt apartments, again, some of these markets are showing up to 15% vacancy from oversupply and overbuilding. Now, I want to go and dive into why this is important and why vacancy hurts so much and the math behind it. Because not everyone does the math on how each vacancy affects their net operating income and affects their bottom line. But I want to go over that in this video to show exactly how much of an impact it can make and how much a 1% increase in vacancy can affect your entire portfolio. So let's go through it. A 1% vacancy can crush around 5 to 10%, maybe even more, of your cash flow. And here's why. Most costs are fixed. Taxes, insurance, payroll, maintenance. Maintenance can be variable, but everything else is fixed. Whether your rent disappears, your costs do not change on those items. It's not like the vacancy on your rental property is going to reduce your taxes. That's just not the case. And what that means is it cuts straight into the cash flow. So here's an example. Let's say you have a 100-unit building. Each of those units go for $1,000 per month in rent. So that means you make $100,000 per month gross rent. Your fixed expenses might be around $60,000 per month, and your variable expenses might be around $10,000 per month, probably maybe even less. And your net operating income at that point, your NOI, sits at $30,000. Now, with that $30,000, after you pay off the debt, you might be left with around $10,000, let's say, in free cash flow for simplicity's sake. Now, once you have a 1% increase in vacancy, what that does is it affects your entire bottom line by a significant amount. So a 1% vacancy in this scenario means that one unit is vacant. That one unit would translate into $1,000 in rent, and now that $1,000 in rent directly affects the NOI, right? Because majority again of those expenses are fixed. Your variable expenses in this case, let's say, doesn't change much because 1% vacancy would most likely not affect the variable expenses too much. So let's say that $1,000 in rent is not collected. Again, your NOI now is at 29,000 because you didn't collect that amount of money. What that in turn does is it affects your entire free cash flow, and now your net cash flow is at $9,000 instead of $10,000. And the difference between the two is 10%. A 10% drop in your net cash flow from 1% of vacancy. That's how big of an impact these vacancy rates can have on your net cash flow, which is the most important because that's what you take home at the end of the day. No matter how you look at it, your NOI and your net cash flow at the end of it is the most important thing, right? And that's why the vacancy rates are crucial to track throughout the entire process. All right, and here's how we manage vacancy risk. So number one, we stress test every deal. We model 5, 10, even 15% vacancies to just see whether or not a building can withstand that amount of stress. And if at 15% vacancy or 10% vacancy, the building cannot cash flow, then we look at what other risk factors are there. Is that something that we want to account for in the case that a 10% occupancy or 10% vacancy happens? Has the market historically hit 10%, 15% vacancies? And what are some of the worst vacancies in large metro areas similar to this that they're seeing? And can that happen? So again, these stress tests are extremely important so you can underwrite as efficiently and as accurately as possible on the deal because of how big of an impact these vacancies can have on your building. Number two, you can target workforce housing. So we like areas where there's high demand and a very stable tenant base. So we don't typically do luxury units because vacancy rates can spike with oversupply and overdevelopment of those. And we know at least the demand is high on the affordable housing side of things. And so that's why we like to stay there. Plus, we get property tax reductions and city and county incentives to do so. So that is one of the major reasons why we like that. Not saying that luxury units are not good by any means, and I'm not saying that luxury units cannot make money. That's not the case. There's plenty of people that I know that are making a killing with luxury construction and luxury buildings. However, that's just not our thesis. And this is something to at least think about. There are some luxury units in great markets that have great occupancies as well. So just take it with a grain of salt. Every market can be different, but those luxury units recently have been hit harder than it typically has been. So that's something to keep in mind. And number three, managing turnovers a little bit more aggressively. So we like to underwrite and make sure that tenant base that we get is very, very good. So we want long-term tenants, which means that we have less turnovers, but also less downtime. And we incentivize tenants to sign longer leases. And a lot of times we put in subsidized Section 8 housing tenants in there. So whenever their lease ends, we're able to renew it at the market rate. We're able to capture that. And number four, keeping reserves. Reserves aren't exactly a mitigation on the vacancy risk. However, this at least does ensure that you have some cash flow and investor confidence when you have downturns. So when the vacancy is high, at least you have some cushion that you know you can deploy that capital for if in case the vacancy rates go up. But these are some of the ways that we manage vacancy risk. I'm curious to hear if you have any others that you typically like to go through when you manage vacancy risk on your end. So leave them in the comments below if you do have any suggestions as well for everyone else. There's plenty more. I just haven't gone through all of them too. So here's some final thoughts. National multifamily occupancy is holding at around 94, 95%, but the story is split. Markets like New York City, Boston, San Diego, and Chicago are quite tight at above 96%, while some Sunbelt metros are struggling a little bit more under oversupply. That could be temporary. If you look at it on a 10, 15, 20, 30-year horizon, it most likely will stabilize. But just at the moment, that's just something that you'll see. And you'll see that in any growing city too. With some luxury properties, they're posting about 15% vacancy. So that's why we like to stick to fundamentals, build in safety nets, and that way those empty units don't sink the whole property and portfolio. So Question for you. Do you know that 1% vacancy can cut cash flows significantly? And how would you guard against it? If you like this breakdown, hit like, subscribe for more real world real estate updates. I'll see you on the next one.